Welcome, and thanks for being with us for another quarterly economic and market outlook webinar. Joining me today is Brian Regan. We will both be participants. We do have other members of the team on the call, and glad to have you joining us. We will try to have an opportunity for questions. If you'd like to ask a question during our presentation, there's both a question box and chat function, and you're welcome to use either. We'll try to keep an eye on both. We do have some prepared content as usual, and we'll get right into that. As you know, it's been a bumpy market recently, and we want to talk to a lot of those factors and tell you what we've been up to and what we've been doing. So we'll certainly be talking about that. Before we get started, I thought I would take a moment to share with you a couple of thoughts that we might want to address. And one is, in times of volatility, it's often comforting to review your financial plan. And we've found that a lot of times clients who have a financial plan completed, when they see how it's functioning in the midst of times of anxiety, it can be a source of comfort to see what's the impact of disruption, and the plan oftentimes still works just as it was expected to. So if you're finding time stressful, it's a good time to review your financial plan with us. And if we don't have one in place, let's make sure we do. I would also suggest thinking about your liquidity bucket. One of the things we talk about often in our financial planning process is the idea of a buckets approach. Having some money that's more stable, having some funds that are invested for the very long term, and some that's in between. And as we entertain times that have increased volatility, it is a time when you want to make sure that you have your liquidity bucket filled, if you will. Have some money in secure assets, stable assets, because it is inevitable. Markets do get volatile at times. Even if you're invested conservatively, there are times you feel it. And so we want to make sure that you have a place, even in the worst of market conditions, which, not that it's necessarily going to be that, but it's just good to have that because it will give you comfort throughout volatile times. So if you have any questions about that, we certainly can talk to you about it. We do have resources, whether it's a money market mutual fund or whether it's some kind of CD ladder or bank resources that can give you a pretty attractive interest rate. We have some possibilities if you don't have a place that you've already prepared for that. Also, just the idea of being prepared mentally. There's a lot going on in the world around us today, and we're going to talk a little bit about that. But it's a good time to be just thinking about heightened volatility and being prepared for that. And if it turns out that we do have increased volatility, as we have of late, are you comfortable with the way you're positioned? Is your risk profile reflected in the way your portfolio is designed? And any questions surrounding that, we're of course here to help you navigate that. It's best to reduce risk when markets are high, as opposed to after they've declined. So we may want to think about whether it's good timing or not. But it's worth a conversation if you find saying, hey, I'm really anxious, which occasionally people do have that kind of concern when there's a lot of news in the world, a lot of things happening, a lot of market volatility. It can be an opportunity to say, what's a measured response to that without doing something overreacting with an all-in or all-out kind of response. Then one last thought as a consideration for you if you are withdrawing regularly, with just perspective. If you're pre-retirement, volatility is your friend, right? It's an opportunity. You want to take advantage of those declines as opportunity to take advantage of more investment. If you are in retirement and withdrawing, it can be one of those challenging times because you don't want to withdraw too much while markets decline. So if you have the flexibility to review whether you need the amount you're taking monthly, if markets decline more, it's probably a good time to revisit. Shouldn't I keep the same rate of withdrawal? If you need the funds and you want to withdraw, that's what this money is for. Totally acceptable. But if you have the opportunity to be a little more tactical and strategic about that, there's sometimes an opportunity to sort of say, I'm going to slow when things are volatile and increase when things are, at their highs. So what are the opportunities? Take a look for opportunities. There may be a variety of them, and each person's instance is different. But if you have money on the sidelines, there may be opportunities along the way as we run into discounted prices for market returns, right? When markets go down, there may be opportunities in that. So if you have money set aside on the sidelines and it exceeds your liquidity needs, maybe that's an opportunity to take advantage of along the way. Additionally, look for considerations of if you're doing a Roth conversion as part of your strategy, market declines can offer you the opportunity to move while markets are down and convert those assets. And then when things get to the other side, you've got more money on that tax-free side of the balance sheet. So in any case, just a few opening thoughts to give you to kick things off. But I think Brian's going to give us a lot of content that's going to give you greater sense of comfort as to what we've been doing and how your portfolios are faring in the midst of volatile times. So Brian, let me turn things over to you.
Thanks, Chris. Everyone's doing well. We'll go right to the agenda. I think most of our clients know who we are at this point. Chris introduced us, so we'll skip that one. Here's the overall agenda. So we're going to talk about index performance, our ETF and mutual fund performance. We're obviously going to talk about the tariffs. We're going to talk about what we did before, as we like to proactively allocate our portfolios. We're going to talk about what we did in reaction to April 2nd, which was a pretty shocking event in the markets. And we're going to talk about certain risks that I outlined in the past, something that I'd be watching, and let's call it recession risk type items. And then we'll talk about what we're going to do, putting all this together for your portfolios going forward. So this chart, as you can imagine, is a little bit out of date because things are moving really, really fast, but the S&P 500 is down through yesterday about 12%. When I say things are moving really, really fast, it's as I talk, it's up about 1.5% as I just watched, so let's call it 10.5% year to date. So things are moving awfully quickly, very volatile from day to day. We can see that the Russell, when I looked at the performance before I jumped on this call, is actually down -18. So yesterday was a pretty rough day. Today I would bet it's probably doing a little bit better. So -16 is probably in the ballpark. But as you can see, these are pretty ugly numbers. I mean, year to date, we're looking at between -10 and -20 on most major indexes. Now, the one index that it's not in here is international stocks, which we're going to talk about a little bit more going forward. They've held up pretty well. So if you had individual stocks in your portfolio, or if you had a more diversified portfolio with more value-oriented names, you did better. And the good news is almost all of you did. So when you look at our ETF mutual fund performance for some of the more active strategies that we have, from the all fixed income to the 85-15, they've done much better than those indices that I just showed. From positive for the all fixed income to down only 5% on the 85 on the 85-15, and just marginal changes in between -1, -2, -3. So if you look at your own personal portfolio, I think you're going to be pleasantly surprised with how you fared, given the headlines, given the enormous volatility that we've seen, particularly in the growth side of the domestic markets. Now, how did we do this? Really just through a diversified strategy. We had fixed income. Fixed income did well. We had international. International did well. We acknowledged that if some of the larger names in the indexes started to fall, that the markets would be in trouble, and we diversified away from those. Now, those were all proactive moves that we did that helped guard against this. And we also did some reactive moves when things got really hairy after April 2nd, quote unquote, Liberation Day, which we'll get into in future slides here. It's always good to keep an eye on the long term. As anybody who's listened to me for any amount of time, I don't really care what happens in the short term most of the time. I'm really judging performance based on at least 3 years. Why 3 years? Because I think that's enough time to ask for people's patience. And as you can see, returns across all the ETF mutual fund strategies are pretty robust over that time frame, well into the black. So this is kind of going into what Chris is saying. The volatility is inevitable, but over the long term, the markets are probably going to reward us as well. And that's something that we always need to keep in mind, especially in times of stress. So the tariffs. So I think this chart kind of tells it all. On April 2nd, we had a very, very dramatic increase in the tariffs. They were building before that between tariff wars that were started with Canada and Mexico. But the 10% tariffs across the entire world, and particularly the escalating tariffs that happened with China, were particularly concerning. In addition to that, we had huge tariffs on Vietnam and Europe, places that you wouldn't necessarily expect. And part of the reason for the surprise is it was based on the trade deficit, which was very surprising because the trade deficit and tariffs have almost nothing to do with each other. Reciprocal tariffs, the thought would be that we would look at the tariffs that other countries were putting on us and put on similar tariffs, and eventually come to the negotiating table. But the tariffs that were built off of this idea of normalizing or bringing back to balance a trade deficit, which shouldn't happen anyways, was just shocking to the entire market. And to me, the biggest concern was it didn't make a whole lot of economic or logical sense. So that's what made us go from a proactive stance, which was already pretty conservative, to getting into a reactive stance, and doing some more dramatic de-risking in the portfolios following that day. Now, one of the problems with tariffs is the Federal Reserve can't really come to the rescue because tariffs are both depressive and inflationary. Now, I highlighted places where it said inflation here, dangers of credit bubbles, absolutely prepared to intervene to calm nervous markets, but then, talking about inflation, if you want to pause this, if you listen to the recording and actually read them, it might be interesting. But the story is the Federal Reserve doesn't know what to do. They're in this position where they can't really lower rates in the face of a slowing growth or a recession because tariffs are going to ultimately be inflationary, at least in the short term. So they're in a catch-22 situation, and right now they've basically said they're going to wait and see. They're in a wait and see mode, so which almost guarantees them to be late to some degree. This has caused a tit for tat discussion between the president attacking Jerome Powell in recent days, which has also been unsettling to the market. So we cannot expect the Federal Reserve to have a put in underneath the market. I think we're in a difficult situation now, and we should expect more rate volatility. And we've seen a lot of rate volatility, and what we can do is position for that. So that's what we're going to do. But this is one of the complicating factors with tariffs and why it makes markets so difficult. There's no playbook. Now, in addition to this, we have this binary risk reward situation, right? So we were trading on the S&P 500 around 6,000 before the tariff talks started towards the beginning of the year. So you can kind of think of that as that's the all good, things are kind of as they should be economy without tariff intervention. And I can make a good argument mathematically without getting into the weeds that with a recession, 4,000 is not unreasonable. So we're in this 50-50 proposition where it's a coin flip whether or not we're going to have a recession or not. It's a coin flip day to day on what's going to come out of the White House, whether it'll be good news or further bad news. And that's why we've had this dramatic changes on day to day. The market doesn't know whether it should start pricing in a recession or start repricing back a shift to normal as we sit in this 90-day window here where we're in a pause on many of the tariffs. So, we've been sitting around 5,000. When I pulled this chart, the market was around 5,420. Now it's around 5,200. Or at least it was to start the day. As I speak, it's probably up a little bit. But as you can see, this all just shows a very, very volatile market where we can go one way or another. And that's something that we need to keep in mind and position for. At the same time, we've had very, very dramatic rate volatility. So the blue line is the one that I really want to concentrate on. We saw this huge jump from 4% to 4.5%. And this has a lot to do with what I was talking about with the Federal Reserve and inflation and a change in growth. So, the economy was slowing, but it was fairly healthy. And then, and it started pricing in some decreased growth from the increase in tariff expectations. And then it didn't know what to do after April 2nd. And the reaction was that inflation expectations were going to go up a lot higher and interest rates shot up. Now, not only did interest rates shoot up, but the dollar decreased. So this makes tariffs especially bad because if it becomes more expensive to buy goods from other countries, to import goods because of the tax rate, well, if our dollar depreciates against their currency, then it's almost like an additional tariff, which it's done so to the tune of around 10%, I believe. So you can tack on another 10% tariff. And at the same time, our borrowing expenses are getting more expensive. So that's important for things like mortgages. It's important for things like corporate borrowing. It's important for refinancing. It's important for discounting stocks. So discounting stocks typically happens on the 10-year treasury because stocks are viewed as long-term assets. In 10 years is a fairly long time. So if we're discounting at a higher rate, you're going to have lower stock prices. So this is all to say that we're going to have rate volatility, we're going to have stock volatility, all until we have some kind of more clarity in the market. And, I can bemoan and guess what's going to happen. And I've decided in recent days to abandon that thought and try to position for what will do good or what will do relatively well no matter what happens. So speaking of which, what did we do before all of this happened, and what did we do in response? We often say that we like to be proactive rather than reactive, and I'm proud to say that during most of these sell-offs, we've been able to sit back and say, hey, look, we were positioned for something like this to happen. And we don't need to make any changes because our portfolio is in good shape. We definitely attempted to do that this time around, but like I said, since the tariffs were based on the trade deficit rather than actual reciprocal tariffs, that shocking element that increased taxes significantly caused us to make some more radical changes very quickly. And so far, so good. Those changes have worked out to the benefit of everybody's portfolios. So what did we do beforehand? The two ETFs on the left, SPTM is the total stock market. It's a very low cost way of getting exposure to every stock in the domestic US market. And the QQQ, which is the NASDAQ 100. When I pulled this year to date, these were down 9 and 11% respectively. As we know, that's probably a little bit worse now. And at the time, we moved to what's called the buffered ETF. So that's the PJN to the right-hand side. We allocated more there. We effectively went underweight stock. Now, what the buffered ETF does is it caps your upside return, probably around 10%. It's a moving target. And it buffers your downside losses around 15% if you hold it for a whole 12 months. So it's done through options activity. But basically what we've done is bought a low volatility asset that we think will lose zero as long as we hold it for a whole year and the market loses less than 15%. And it has upside. So ultimately we've traded something that's been down, called 10, 11% for something that's been down 4.5%. Ultimately, that was a good move. I don't like seeing red, of course, but this was on a relative basis, a good move. And I'll credit Chris. He was the one pounding his fist on the table at the end of last year, saying, I really think it's time to take off some risks. Valuations are really stretched, and credit to him, he was right. Now we had to react to things that happened after April 2nd. As I said, it was a very shocking event. So in our alternatives bucket, we're really trying to accomplish two things, right? We're trying to accomplish getting returns with less volatility, and we're also trying to find uncorrelated assets with the rest of our portfolio. Um, to that point, that's where the buffered ETFs sit, right? This is less volatility, but it's stock like correlated risk. We're trying to get some good returns with less risk in that strategy, so that fits in our alternative bucket. And we also had something called a carbon global, CraneShares global carbon strategy, which is there's different districts that has carbon pricing basically. So the greater the economic vibrancy, the higher these carbon credits become. And when things are going really well, particularly in California and parts of Europe, the carbon shares tend to do very, very well. And they're also kind of not correlated on a day-to-day basis with the S&P 500 at all. So I made a nice little buffer to smooth out the volatility of the portfolio. Now, when I'm looking for things to change quickly, these are kind of an easy place to go. I'm not expecting this to be core parts of our portfolio, and I also wanted to replace these alternatives with another alternative. So the one thing that we feel confident about after April 2nd is a chaotic environment. And what we'll do during a chaotic environment is something called the VIX. It's also called the fear gauge. It's something that typically does well when things are very, very volatile. So we took a very, very small position in it, and it did very well in a short period of time. I believe we did around plus 21% over a few days in people's portfolios. We had a cap on how much we were willing to take in gains, and we had a cap on how much we were willing to take in losses on that. But that worked out very well, and the big reason why we were comfortable doing this is because this would have been heavily negatively correlated with the stock market. So the thinking was, if this is doing really bad, well, then the stocks in your portfolio are ripping, and if the stocks continue to do poorly, this will be a nice offset. And luckily, luckily or unluckily, it depends on how you look at it. I'm happy we made money in the asset, but stocks continue to do bad. So that's why we made money in the asset. So, this actually in some ways made our portfolios less risky because it dealt a little volatility. But at least we were able to make some money on something in a short period of time to make our performance a little bit better during a very tough environment.
And Brian, it's worth pointing out that that kind of a position was entirely very tactical, very circumstantial, not the kind of thing we typically would invest in long term, but we thought it was a good hedge to risk under the circumstances. So nice call on that
Yeah,
one.
we've never done that particular trade before, or at least I haven't, not while I've been with AMR working with Chris and Kristen, but we've done similar things during the pandemic. For example, there was kind of outrageous value in weird places that we were able to take advantage of. So when there's kind of crazy things that are happening in the market, sometimes you have some crazy opportunities to take advantage of. So it's not in the norm, as everybody on this call, everybody listening probably knows. We like to do analysis and make changes quarter to quarter based on, good solid data and research. But sometimes you need to make some mid-quarter adjustments in the face of, opportunity or to dull risks, and that's what we did here. So this was a move that we did to dull risk. So we did this on April 3rd. On the morning of April 3rd, I bothered Chris very early in the morning, and I said, hey, look, I really want to make this change. And as a lot of you know, we had small cap in our portfolio, which I thought was a good diversifier. When interest rates were heading down and continuing to head down, we thought this was, a good place to be. With the tariff changes, that philosophy kind of went out the window. In addition, it made small cap stocks less competitive in the market. So we made the quick decision to move on from the Vanguard small cap fund and into the high yield. So the idea here is that if the market starts to recover, high yield will also do well. If it doesn't recover quickly, we are getting a nice spread on our high yields, and we'll see that in later later slides, that we're going to get around a 9% return, all else equal, if we just hold on to the high yield and the position that it's in now. At least that's my expectation over the long term, which is a pretty nice return for less risk. So we're taking less risk and we're still expecting a nice return, and we avoided some catastrophic losses from the small cap area. I looked at this morning. I think since we made this trade, the high yield's down about 2%, and the this particular fund's down around 11 or 12%. So you can see that spread was favorable for us. We've avoided some extra downturn from that as well.
Well, it's worth reminding listeners that our clients that high yield bonds um, are bonds, but they do have risk, credit risk, and although that risk is less risk than stocks, so they're correlated to stocks. They may be affected by similar forces. So, at times of distress in the markets, Brian, you've done this before in 2020. Um, there might be times when you look at things and say, well, high yield bonds can give us stock-like exposure, but less with less risk in the process, and that's essentially what you were doing with this trade.
Yeah, it's a great way to sum it up. It's a little unconventional. I don't know if there's a lot of other portfolio managers or asset allocators that are willing to do the same thing. I don't really know why though. And part of this job is kind of challenging conventional wisdom and doing things that we think are right for our clients. We also have an individual stock portfolio. Very quickly, I realized that Nike, Apple, Disney, and Northeast Bank could be heavily affected. I'd say I was right on 3 out of 4 of these. Northeast Bank seems to continue to do well, which I think is interesting. A lot of their exposure is US based. It's a regional bank, which is why I think it's held up well. I don't necessarily regret the trade, but I like holding things that continue to do well in the face of difficult times. But Nike and Apple, their supply chains are heavily based in China and Vietnam. Apple has a little bit more diversified exposure into India, which also has a significant tariff on it. Walt Disney has a park in China. Their movies are global. I think it's going to be negatively affected, pretty significantly over time. We've seen that the stock has struggled in the face of increased costs in the past. That's definitely going to be a theme of the tariffs. So we moved on to that. We've been sitting in cash. We have about 10% cash in a money market fund in the individual stock portfolio. I'm comfortable with that for now. Of course, I want to get it reinvested. But to say that I'm happy with how the individual stock portfolio is performed is, a huge understatement. I'm very, very proud of it. It's done very, very well. So, I'm going to look to opportunistically get this reinvested, and I'm looking every day to try to get that cash invested because, ultimately, the longer you're in the market, the better you're going to do. So, this has worked out so far, but if we don't get the money working again, then, I do think we'll miss out in the long run, as we've preached and as we've said on prior slides.
So if you have a question, don't hesitate to put it in the chat or the question box that you can find, at least on my screen. It's at the top of the screen, but in any case, maybe on some kind of a menu bar for you. Brian, I think a couple of things just as a quick follow-up to a comment you made when it came to the question of the bond side of the portfolio being more defensive with that lower duration that you mentioned. How does that compare to an aggregate bond index? Just so people have a sense of perspective, how much less interest rate sensitivity that might reflect.
Yeah, good question. I don't think I was very articulate in explaining that. So, I appreciate the follow-up. So the aggregate bond index takes about 7 years in duration. So simply speaking, that means if the interest rates were to go up by 1%, particularly at the longer end, that you would lose 7% in your portfolio. Now, you're also getting around 5% interest rate. So let's say under that circumstance, your total return would be -2. Now we are positioned today at 3.3 years. So if interest rates were to go up 1%, we'd lose about 3.3%, but we're getting, call it 5% in interest expense. So under that same interest income, so under that same scenario, we'd actually be, on the positive by close to 2%. I'm going to reduce that risk even more to about 2.2, 2.3 years. So if interest rates go up by 1%, we'll lose 2.3%, but we'll still gain about that 5% and capture, 2.7% in total gains. So what we're really doing is positioning for the risk that interest rates could go up significantly from here. Now, the flip side of that is if interest rates go down, the longer end does better. So you might ask, why would anybody allocate to the longer end? Well, if interest rates go down by 1%, that longer 7-year in duration will go up by 7%, plus they'll get their interest expense by 5%, and you can get a 12% return. That can be very attractive, and that can happen during a recession. That's typically when something like that happens. But again, we're in this sticky situation where we got inflation and recession butting heads, and it's just so unclear which one will win out. I don't want to be in a 2022 situation where interest rates jump up significantly, or a Paul Volcker situation of the 80s where interest rates jump up significantly and the bottom side of your portfolio, which is supposed to be your stable part of your portfolio, ends up hurting you. So, that's ultimately what we're trying to avoid. We're trying to
In the
preserve the
meantime,
capital.
your cash flow, the income you're getting from those bonds is still attractive and competitively so relative to the alternatives, right?
Right, exactly.
I think one of the things I want to convey, and again, if you want to ask a question, don't hesitate to put it in the chat. One of the things that I want to convey is that you get a sense I hope our clients from this webinar get a sense of the active management we are doing, both proactively and in some instances reactively based on what's going on around us. So that's part of what you're paying for, and we're trying to be responsive to. And so far it seems like these have been good moves, and we've been happy with the way our portfolios have responded to market conditions. Again, I want to reiterate, if you have any anxiety about what's going on in the world around us, it's a good time to make sure your financial plan is current, because it gives you context. And a lot of times that context can give you peace of mind that even though there's, as investors, we're prone to endure volatility. That's just the nature of investing. But we want to structure a plan that works for you and meets your cash flow needs and long-term outcome objectives. As we have talked today, we generally encourage our clientele to try not to let their politics drive their investment decisions. And I want to make sure that, as you hear us talking about a lot of the issues that are influencing your portfolio today, it may sound like we're talking about politics because there are various policies that are coming out of government right now. And we just want to be clear, this is not intended to be driven by political bias as much as it is about reacting or recognizing what's happening from a policy direction and how do we position your portfolios in the context of changing dynamics, really largely for our trade experience. And that, whether or not how that will actually play out remains to be seen, because we're not clear if it's what's actually been prescribed or if that's some sort of negotiating or just exactly how it will play out. So that makes it a little challenging for you. And as Brian has talked about, we're trying to position for a variety of outcomes in the way we're planning for the portfolio. I would say it is probably fair to say that in these incredibly challenging times for how to position in your discretionary managed accounts, it's probably fair to think that if you are a conservative investor, it's more likely than not that we'll probably err on the side of caution. We're a little underweight exposure to markets in that scenario. And when there's an opportunity, our more aggressive portfolios, I think we will be eager to think opportunistically as we look ahead. I don't know if that's a fair way to characterize it. Brian, you may want to clarify that. But you follow my point that um, we are trying to thread the needle here a little bit and be positioned cautiously now. And when the opportunity to be more, when there's more clarity, try to take advantage and lean into where there's opportunity. Anything to add on to that, Brian?
No, I think you did a good job summing it up, particularly around we're not reacting to politics, we're reacting to policies. I think that's something that's lost in the conversation today. This is active policy. We didn't react to it before the policy was enacted. But we did, but it would be foolish not to pay attention to actual political realities that are happening. A lot of times people concentrate on speculative things that could happen, and that drives a kind of a fear cycle, or maybe an overly optimistic cycle. And I don't think that's what we're doing. We're reacting to the situation on the ground, and I think that's the right thing to do. Now, the one I completely agree with Chris that we do make active and decisions and sometimes tactical decisions, although rarely. And I will say that sometimes when we are taking a more optimistic approach, oftentimes it's not consistent with how conventional wisdom might think, and that's something to be mindful of. And the reason why I say that is just because the market's going up doesn't mean I'm optimistic. In fact, it might mean I'm pessimistic because the prices are too expensive. So you have to take into account the economic reality in the price, and more often than not, the economic reality and the prices are fairly reasonable. And that means that we don't have to make wholesale changes, and that we can do quarterly, things. Sometimes the price gets way too low, and then you can be really optimistic, and that can be really tough for a lot of people because that means that things are, probably not going well on a price basis, and might be painful to open up your statements, but that can be the exact right time to put your foot on the gas. So I would tell people that I can't wait to put my foot back on the gas. I think about it every day and when we're going to do it. And I beg of everyone's trust that just as we were cautious when caution deemed necessary, that allow us to be aggressive when aggression is necessary.
I don't see any questions at this time. And so I want to thank everyone for participating today and those who are listening on the recorded version. If you have any questions as a follow-up, please do not hesitate to reach out to our team. Additionally, and incidentally, if you didn't know, our email addresses are first initial, last name at wealthenhancement.com. So you can reach me at cboyd@wealthenhancement.com. As far as some of my earlier comments, it may be a good time to review the financial plan, make sure everything is working as intended, make sure you have the proper liquidity, and just mentally be prepared for volatility as we have a lack of clarity in policy for a little time here. And that can affect impact on earnings and markets generally, both equity and fixed income. And we will continue to do our best to guide your portfolios to within your stated risk profile and to the best of our ability. So thank you for that trust. And if you have any questions, reach out to us.